future CPAs. This is Yugandhar from Bharat Teach U.com, CPA, CFA, ACCA and CMA. Now we discuss about revenue recognition, and it is a portion in the revenue recognition. We will also discuss journal entries which are related to this particular topic under revenue recognition. Transaction price allocation. So under revenue recognition, we all know that 5 steps approach. Okay. Under this is the 4th step approach. So first, after identifying the contract and the consideration, price will come. This price allocation, because some discounts are there. So let us discuss about the concept and you can easily understand. It is really an essential concept in the revenue recognition. In contract, compassing multiple performance obligations, it's imperative to allocate the total transaction price to each obligation. So in the particular contract, we have different obligations to perform and to complete the particular contract. We have different obligations, duties or responsibilities by the provider, service provider or say product provider. And for all obligations, they have different prices basically, but we are giving direct a lump sum price. So you need to allocate according to the proportions. Okay. This allocation is a pivotal for accurate revenue recognition. Now, what is the methodology and implications under this? The allocation should be reflect the amount each performance obligation contributes to overall contract value. So for example, you have different obligations. For example, piping, okay, in a construction, piping, fittings, okay, and you can also say painting. In a building, all these things are the required elements to complete that particular contract. These all are the integral part of the construction contract. So these cannot be divided. So once you did all these things, then only that is useful for office purpose, or you can say housing purpose. So all are the integral part of one contract. So for all these things, you are collecting 300 million, for example. So for each of this is a different prices. Okay. For example, it takes 110 thousands, and it may be a 120 million, and it may be a 150 million. For example, I'm saying. So all these things are the different prices. You can observe 110, 120 and 150. It is more than 300. So if you are taking a lump sum price for the entire contract, and individual standard loan prices are different, not at all closer to the $300,000, almost all 80 million extra. So this is the discount, right? So how can you recognize your revenue if you are providing an individual standard loan prices and you are taking lump sum amount of 300 million? So this is most important for the revenue recognition point of view. It is a crucial as it impacts how and when revenue recognized. How is a question mark, because 300 million now becoming more than 300 million if you take a stand-alone prices. And when you need to recognize the revenue, when and how, this is the question. So students are facing a difficulty here to identify the exact price of each individual piping, fitting, painting, like that. Individual prices, that is the how. And second thing, when you need to recognize your revenue in the books of accounts, because you are providing these services step by step. Now, standard loan selling price at a closer look. A standard loan selling price is a key component in the process. It represents the price at which the goods or services could be sold separately, because you are selling it separately, the prices are different in the market, and the price forms the basis for proportionately dividing the total transaction price among the various obligations which are at standard loan prices you have, and determine the significance. Establishing these prices at onset of the contract, okay, provides a benchmark for subsequent allocation. It's a fundamental step in ensuring the revenue is recognized in a manner that accurately reflects the value of each obligation. But you are not showing, in journal entries you are showing separately, but you are not showing the actual standard loan prices which are available in the market if you are providing those services separately, but you are providing a lump sum. For this, navigating discounts in a contract. Basically, I am dividing the entire concept into different subheadings, then only you can easily understand. Because if you go and check in any other standard books, they given direct theory, it is difficult to the students to understand. So I am preparing a materials with easy understanding and differentiating, dividing the entire concept into different points for easy understanding. Each and every paragraph you can read and understand clearly. Navigating discounts in the contract, understanding the discounts. What are the discounts? Because you are taking an aggregating price 300 million, that you know that, and different prices are, standard loan prices are different. Standard loan price of the products are different. You are providing all these services for 300 million only. In scenario where aggregated standard loan selling prices surpasses the total contract value, a discount is going to be evident. Discount is evident. Proportional allocation of discounts. How you are going to allocate proportionally? We will also do one question on this. Before that, you understand clearly. This discount isn't attributed to single obligation, because overall discount you are getting, overall discount you are getting approximately it is 380 and you are taking only 300. So 80 is the discount you are going to attribute to across the obligations. Okay, the approach maintains the proportionate value of each obligation, ensuring a fair representation, because you need to provide your books of accounts true and fair values. Okay, so ensuring a fair representation of the contract's economics. Okay, see, this point is also a regulation point. Okay, in regulation, true and fair view presentation you need to do. So you need to present according to the auditing. Also you need to put some notes to the financial statements, how you are recognizing your revenue. Okay, once reading the one concept, you need to link with the other concept and you need to remember properly. So there is a financial notes will come here. Addressing variable considerations. How you are going to address variable considerations? Concept and implications. Variable considerations refers to the components of the transaction price that can change based on the future event. These changes could be linked to entire contract or a specific obligation. And the strategic allocation. Allocating variable consideration requires a strategic approach, ensuring that fluctuations in the transaction price are reflected accurately across the obligations, mirroring the initial allocation strategy. Handling charges in the transaction price. Managing adjustments. Post-contract inception, any changes in the transaction price must be allocated using initial methodology. Stability in allocations. It's important to note that the post-inception changes in the standard loan selling prices do not lead to reallocate the transaction prices, maintaining consistency in revenue recognition. Consistency principle. Okay. Now you understand what is the allocation and everything based on this example. In this question also I divided into parts for basic easy understanding. For example, if it is a software company, Tech Solution Incorporation enter into a 300,000 contract with a customer. Okay, this company is going to recognize revenue in the books of accounts, and how and when they are going to recognize revenue we can discuss now. This contracts including delivery a software license, providing installation services, software license A, and providing installation B, and offering technical supports for 4 years. This is the 3 types of different services are going to be provided, and this company also provide for others, also provides individually. This is also they can provide separately, this is also they can provide separately, and technical support also they can provide separately. For example, if you are a customer, you want to consult the tech solutions for only software license, they can provide you, and you already have a software license. If you are asked the installation service, they will also provide you, and you are already installed and you have a software, you are only asking for the technical supports, they will also give you. That is the reason the individual standard loan prices are different. Software licensing 200,000 and installation 30,000 only one time. Software license is also one time, and technical support is 4 years, each year per annum they are asking 40,000. Total comes to 160. So you can observe this 230, 200,000 plus 30,000, 230,000 and 160,000. Total how much? Total is 390,000. 390,000 is the total. But how much they are asking? They are only enter into a contract with 300,000 with this particular customer. So how they can divide each standard loan price? The standard loan prices are much higher and they are asking only 300,000. That is the discount, right? Discount is coming. Now we are in the question only. Functionally and independence. Functionality and independency. The installation service and technical supports are available from other vendors also, and the software is fully functional without these services. Understand? I already told you. Okay, in the previous, while explaining the question A, B, C, they can also provide separate standard loan prices to each individual. So other vendors also available. So functionality is okay. It is functional. It is functional. If you are taking services from anybody, you can buy only license here, or otherwise you purchase the license somewhere, and you can also we will also help you for installation, or if you want technical support also we will provide you. So this is functionality and independence. So please understand, in the question they don't give you separate paragraphs and clear explanation. You need to understand while reading the question only. But for constructing the question like this, for you, for the better understanding, I am constructing a question like this. Now what are the payment terms? The full contract amount is payable upon software installation. That is scheduled for April 15th, year 1. Understand? So please understand. So the software technical support is per annum, but we are enter into mid of the April 15th. In the approximately in the second quarter we entered. Please understand this. Please, you need to remember while reading the question only. Payment terms, it is payable upon installation only. In beginning they are paying. Okay. Detailed revenue recognition strategy, how the strategy is there, and our question is when you need to recognize the revenue and how you need to recognize the revenue. So when is, that is on February, that is on April 15th, year 1 only, because they clearly mention that the full contract amount is payable upon the software installation. Now, detailed revenue recognition strategy for Tech Solutions Incorporation. Now, comprehensive prices. So total prices are 300,000 and the contract value they are asking only 300,000 is less than the sum of standard loan because they are giving the discount. Now proportionately distribute the contract price based on the ratio of each obligation standard loan prices. So how can you recognize that? So I'll come to that part again after this. Now software license ratio, installation service ratio and technical support ratio. So this is the standard loan price and the total standard loan prices and contract value, and proportionate is this. So basically the standard loan price is this and the contract value of each obligation, right? So each obligation is discounted. You can also calculate like this. Proportionate is 51.28% and 7.69% and 41.03% is for technical support. Subdivided. See, proportionately calculated. Now means it is very simple. This is the 100%. Okay, how much is the this? And this is the 100%. How much is the this? This is the 100%. How much is this? So that is the percentages. Now please understand, I am going to the previous part, software license. When you need to recognize, this part is showing you when, okay, and this part is showing you how you understand how you are going to recognize the revenue and when it is most important. In the question they clearly mentioned that is payable upon software installation. So that is April 15th. Recognize revenue upon installation as This when the license is transferred to customer. Okay, means one performance obligation is done, but you are recognizing the revenue immediately, right? After installation, transferred, installed, and you need to recognize the revenue, especially for software license. Installation, so you installed already, for example, you installed, completion of the installation, then you need to recognize the revenue. When it is completed, you need to recognize the revenue. And second one, this is also same. Revenue for the support services is recognized over 4 years of period, aligning with the duration of the support, because you provided the support, then you recognize the revenue. Okay, so this is for 4 years. Every year you need to recognize the revenue. Ending of the year, you need to recognize the revenue. And this is after installation, immediately you can recognize. After installation, immediately you can recognize. This is also same, because see, because you transfer the license, but it is not useful for them. Once it is installed, then you can recognize. So both are at same time. Software license and installation, both are recognized. You should recognize the revenue immediately after installation. You understand how and when you cleared. Now I am coming to the question. You already know the numbers, because very simple. Okay, again you can see the numbers 230 and 160. So now on first year, 5th April, what is happening? Inception, the contract inception. So on contract inception, what is happening? You are not yet provided any sort of services, right? It is liability, contract liability, or you can also say unearned revenue, because it is you are not yet provided, but you received the cash. So unearned revenue. You can also write contract asset or unearned revenue. Okay, but basically it is correct. Writing a contract asset is correct. Contract asset and contract liability both are created because you received the amount is in your bank or in your hand and not yet provided the services. That is the reason contract liability is also going to be created. And upon completion of installation, so you are installing immediately. Okay, when you are installing immediately, so your liability is going to be reduced. What sort of liability is going to be reduced? So your license liability and installation, both liabilities are going to be reduced. So previously credited, now it is debited. So liability cancelled. Then liability cancelled, the same amount of revenue you are going to be generate. So revenue recognition is happening when? Upon the installation. What two types of revenues? What are they? One is 200,000 revenue, but you are recognizing $153,846 only. And second one is installation 30,000, but you are recognizing $23,077 approximately only. These two are the liabilities reduced, and you created revenue recognition. When the revenue is coming, you need to write credit side. Revenue is recognized upon the completion of the installation. So when you are recognizing upon the completion of the installation, because the agreement says that. And at the end of the year, you provided the services, right? At the end of the year, you provide the services. Basically, what is happening here? I given directly year 1, you are starting April 15th. So the books of accounts are closing December 31st. So how many months? Hardly 8.5 months. So you need to recognize revenue for the first year 8.5 months only. Okay. So what is that actually? Technical support is 4 years. So 40,000 per annum. 40,000 per annum. Per annum it is coming only 30,769. This is because proportionately discounted. So 769 divided by 12 into 8.5 months in the first year. Second year you can take full amount. Okay. Third year you can take full amount. Fourth year you can take how much? Because first year you took this, fourth year how many months? Remaining months. Okay, because only till April 15th you need to do. So first year 8.5 months and the last year only 3.5 months. You are going to provide the installation up to April 15th of the fourth year. Now, so explanation. At inception, total contract value recognized as a liability and total contract value whatever you received the amount is an asset. Upon installation, you are recognizing the revenue and asset is going to be adjusted and revenue is going to be recognized and liability is going to be adjusted. Okay, now means liability become revenue. Annual technical support each year same proportionate. When you are providing the at the end of the year you provided your services and you need to recognize the revenue. How many months? First year 8.5 months. But directly this question says that for easy understanding I given contract liability first year full year means April 1st to January 1st to December 31st. You assume like that. Okay, right. I am happy to help you. This is Yugandhar from Bharat Teach U.
Our unique teaching methods set us apart. We offer a multitude of multiple choice questions, engaging video lectures on a wide variety of topics, and pass guarantee classes. Plus, our convenient Zoom sessions mean you can learn from the comfort of your own home or anywhere else you choose. But we don't stop at just teaching. We believe in transforming. Our students don't just pass exams, they become well-rounded, competent professionals. We achieve this transformation through comprehensive task-based simulations that provide real-world experience and shortcut theory memorization techniques that make learning efficient and enjoyable. And if you're worried about juggling work, studies, and personal life, fret not. With our flexible course timings and round-the-clock student support, we ensure you get the best learning experience without compromising on your other commitments. So why wait? Empower yourself with the right skills, knowledge, and mentorship. Enroll in Bharat Teach U today and make those dreams of financial success not just a possibility, but a reality. Bharat Teach U, where average students become extraordinary professionals.